Joining us now to talk more about the latest economic data and what the Fed's paying attention to. Michael Gapen, head of U.S. economics for Bank of America Securities. What's your base case, Michael?
Our base is 2.
I'd go for another. It is. I'd say I'd go for another 25 because I got like the Fed futures on my side. But you think eventually the other ones come in line and that we see a second one back to back at the next two meetings?
We do have it back to back. I think Powell's guidance last week about it being a slower pace puts the risk that the second one could be at the November meeting. And yeah, I think you have to discount that second one more, given that the trend in inflation is lower and maybe it dissipates more quickly. But we're on 2 in July and September.
The inflation numbers that we see ahead of us, what's going to dictate whether those are hot or cold? Is it going to be services? Is it going to be the labor picture? What is it now? Used car sales?
Yeah, I think the 2 key categories, at least that we're fixated on, are used car prices. Do they kind of come out of their little surge and start falling again, like the data, the wholesale price data suggests? And the rental inflation story, I think, has legs in terms of shelter should continue to diminish, and in our forecast, there's probably some downside risk as we get into Q4, Q1. Maybe that shows up sooner.
Then why should they hike?
Well, I think because it's not decelerating quickly enough for them, that there's stickiness enough. So the downside risk, I think, comes from these 2 categories. But I think in the bigger picture, core goods haven't started falling yet, and most of us had thought that they would be by now, more on a broad-based basis. I mean, do you want to make monetary policy on used car prices alone? Probably not. So I think the general stickiness, the durability of the recovery itself, strength in the labor market, errs you on the side of doing a little more.
So is that going to be just right for inflation and we avoid a recession next year, or do we have one next year?
We have one next year in the forecast in Q1 and Q2, but it's pretty mild. On a Q4 growth rate, it's flat for the year. So we're kind of
not enough to make the Fed actually cut rates in the first half of the year?
We have the cuts coming in May. In May. So yes, I think enough where they'd have enough confidence that inflation is coming down. You could switch to cuts in the first half of the year.
That's a quick turn from continuing to hike.
And it sounds pretty market friendly to me for stocks. I mean, it
is. I mean, depending on how you look at our forecast, we've got 1 foot in this mild recession camp, 1 foot in this growth recession camp. But that's kind of where the data is coming, and I think the favorable news for that outcome, Joe, is the rebound in labor supply has been dramatic. Yeah. For most of last year, the shortfall in labor supply was running about 2 million, constant for the whole year, which made us worried that your correction in the labor market had to be bigger, your downturn risk was more severe. But we're now maybe 400,000 short. And so the rebound in immigration, the rebound in participation, right, it means your gap between labor demand and labor supply is smaller. So it's closer to a Goldilocks outcome.
Companies for years have made X amount per year in terms of growth. And it was always about the cost of money. And I can remember the cost of money being a lot higher and companies really doing well. Why should we be afraid of 5.5%?
I mean, we shouldn't, in the sense, to your point, can they get it right? The Fed is essentially trying to blend 2 messages here. One is, ultimately, we'll do whatever it takes to get inflation to 2.
But this doesn't seem that draconian to get back to 5.5%.
That's the Volcker side of the Fed's credibility, right? The Greenspan side is, well, we want to do this without injecting undue harm.
Right.
So let's try and moderate this.